If you are here today, welcome. Thank you for watching here live on YouTube. We're going to be doing these shows once a week. Every Wednesday, we're going to be coming to you live with different topics about building wealth, right? How do you build wealth, and how is that structured? And so every series or every episode, I'm going to break down different concepts and strategies. You can also ask your questions and anything that you really like, obviously within reason. Please make them reasonable. I will answer any question that you throw at me, because the goal here today is to give out information, to be able to share something that could impact your life and help you build generational wealth for you and your family. See, I believe that your goal is not to be rich, it's to be wealthy. And I think that we get stuck being rich all our lives, thinking about the end game as being retirement, thinking about living life as about having the nicer things, about living and enjoying life. Although those are parts of it, the real truth is if you want to be wealthy, you got to stop being rich and live wealthy. And so our strategies on these talks every Wednesday is going to be directly related to the strategies to build wealth. Now, if you're just joining us here on YouTube, on YouTube or Facebook, just so you know, if you want to come to our live event, please go to our YouTube. And can we put the URL in there, maybe in the chat? Maybe go in from yours, and we're going to put the URL. You can come watch me live on YouTube. If you like the audio better, you probably want to come to YouTube. If you want the channel to get grown and bigger, please help me. And if you are watching us live on YouTube, please make sure you subscribe to our channel. I would greatly and utterly appreciate it. So our topic this week is short-term rental, long-term wealth. Short-term rental, long-term wealth. And if you have questions, put them in the chat. So when we talk about short-term rental, I want everybody to know that STR equals short-term rentals. Okay? So if we think about short-term rentals, let's go to the next so they can see it. There you go. So we got short-term rentals. Typically, this is Airbnb, right? We all think about that, and typically maybe VBRO. And there's a few others. I think even Hotels.com is now doing that. I think they're doing it. There's a few other sites that are starting to do this short-term rental strategy. Okay, they're letting you list. So we think about, I just want everybody to be on the same page. When I say STR, that means short-term rental. Okay, so we're on the same page. Now, I'm going to start talking about short-term rentals as it relates to taxes first, because even if we want to talk about the concept of buying one and how you make money and all that stuff, I could do that. But let's talk about how money flows, right? So we have two different buckets. I'm going to do buckets. I love buckets for some reason. I keep on drawing them. So we got buckets. Now, one is not supposed to be bigger than the other, but I guess one is, right? So this is what we would call passive income. And I'm going to try to make this a little thinner. Maybe that'll help. And then this one is there you go, passive income. Okay? So we have two different types of income. Now, I want you to think about non-passive and passive, right? So we think about passive income as being real estate. And sometimes we qualify it. So it is real estate. Actually, let's just fill it up, right? So let me put this in here. So it's real estate, right? We think about real estate. That's number one. Now, we also think, what about stocks, or what about investment accounts, or maybe interest or dividends or crypto and all that stuff? I'm sorry to tell you, but passive income is not those things. In fact, non-passive income is wages, right? Businesses, and there is a caveat to that. I'll talk about that in a minute. Businesses, investments, and other things. There's only two things that qualify for passive income, right? So we got RE, real estate, and the second passive income bucket is going to be non-materially participated business income. So it would be biz. I'll just put biz that you do not participate in. Don't participate. Don't critique my handwriting. This thing is not pointy. It's flat, okay? So there's only two types of passive income, and there's a ton of non-passive income. Now, the reason we need to understand this in order for us to be on the same page, the only reason we got to understand that is because how we make money, dollars, has to go into this buckets, right? So let's say you had a pool of $100,000 this year, okay? Depending on how you earn that money, it gets divided. Did we get better, by the way? Okay, I'm going to swallow the mic. No. So you have to determine which way they go. And some are going to go passive and some are not. So if you had rental income, well, that would be in your passive income. If you had wages or a business or investment income, capital gains, all of that comes into passive, non-passive income. So when we buy real estate, what we're really trying to do is we're trying to get this income to offset this income, right? We want to have an offset. What does that mean? If I made 200,000 over here, are we okay? And over here, oh, I need to turn me. And over here, I made 100, or actually, if I had a negative 100,000, I want it to subtract from this. So I want it to be like negative 100,000, and I'll erase and do higher again. So I only show 100,000 in income. This is what everybody wants. Everybody wants to have passive income that maybe could be a loss, and then they want to do is they want to take it and offset their wages, their business, their capital gains, all of those things. Oh. So if all we're doing is trying to get to the scenario, we have to understand how we do it, okay? We have to understand how we do it. So for the sake of this conversation, we've got passive, non-passive. The goal is to take losses from my real estate and apply those losses against this. Okay, so now we're on the same page, hopefully. If you guys got questions, put them in the chat. So we got real estate, passive, non-passive, okay? So then what we are trying to do now is buy real estate that we can take a loss on. So we're going to use Airbnb in this case because I like Airbnbs, or at least I like that there is a strategy. I'm going to show you the Airbnb loophole. And actually, it's not called Airbnb. We just call it STR, standing for short-term rental. So what we're going to do is we're going to take the Airbnb loophole. And so what I want to do is I want to go find a nice little Airbnb, right, with a nice little house. Maybe it's near a beach. Maybe it's near somewhere. And I want to rent it, right? I mean, I want to buy it. I'm going to rent this little bad boy out, right? This is my little house, little door. I'm going to rent this thing. We good? All right, cool. And I'm going to buy this thing, let's call it for $500,000. Okay? And it's ready to be rented, so I buy it. I got a $500,000 property. Okay, cool. Let me show you how you build wealth now. So this is what I'm going to buy. Now, I bought it with my income. So let's say I made $200,000 this year as a business owner. Okay? We're just going to call it a biz owner. Maybe I own a plumber or something. This is my income. I made $200,000. I want to buy this $500,000 property. Okay. Now, when I buy a $500,000 property, the IRS lets me utilize that as a rental. So let's just use some cool math, right? Let's say I buy it for $500,000 and I'm going to rent it. I'm going to do Airbnb, and let's just say I'm going to do math with you guys. Okay, if you're here, I'm just going to do some math. Okay. So what I'm going to do is I'm going to say I'm going to rent this thing. The goal is to rent it 30 nights, right? A month, 30 days a month. We all know that it's possibly pretty impossible, at least based on data. The average monthly rental percentage per month for Airbnb is about 74%. Okay? So what I'm going to do is 30 days times 74%. That means I'm going to rent it 22.2 days. I'm just going to leave it at 22, okay? So I'm going to just 74%. Okay, so 22 days. Now I need to know how much I can rent it for. So let's say we could rent it for, I don't know, $200 a night. So I'm going to get 22 times 200. I've got $4,400 a month, okay? Now I got $4,400 a month. Now this is called what I call my gross income, GI. Okay, my gross income is $4,400. Now, what I want to do from the gross income is I want to subtract expenses. So I'm going to minus expenses, right? And the typical expenses for things like this are going to be insurance, taxes, right? Fees, maintenance. I can't even type right here. Maintenance. Anyway, so you got all these things. And usually, just to be clear, it's going to be about 80%. That's usually, it could go from 60 to 80, but we're going to use 80%, meaning 80% of my gross income. So I'm going to do 4,400 times 80%. That's 3,520 bucks. So I'm going to just subtract that. 3,520. So I'm going to do 4,400 minus 3,520. I've got $800 and $888 is my net operating income, NOI. Remember that acronym, NOI. Now, it could be less, it could be more, but I'm being very conservative, right? I could be really aggressive and say my expenses are at 20%, but that's bull, right? Or I could say it's 30%, and that's bull. But I mean, I'm just going to be a little conservative, playing devil's advocate here. I want to make sure that we are profitable. So I made $880. Whoop-dee freaking do. By the way, it's less than $100 a month. But I still made it, and it paid my mortgage, and I feel good about it. And by the way, I'm now that I'm really rethinking it, 80% might be aggressive, but let me show you something. So I make $880. This is my net operating income, NOI, okay? I'm missing one expense down here, which is called depreciation. So depreciation is an expense that the IRS allows us to take on assets. An asset is something that has a useful life greater than 1 year. Anyways, so net operating income, 880. Depreciation is an asset, anything that has a useful life. I grabbed my phone for a reason. This is an asset. So this asset has a useful life greater than a year, meaning it could last me longer than a year. The IRS allows me, are we good? It allows me to depreciate it, okay? And they give me certain schedules. They have a schedule, and that schedule has different, for every asset, they have a schedule. For homes, single-family dwellings is what they call these. Single-family dwellings, residential, the depreciation schedule is 27.5 years. What that really means is that you get to take a deduction for holding the asset for 27 and a half years. So what I do, Facebook and YouTube friends, I have to calculate how much of a deduction I get if I bought a $500,000 property. Now, for the sake of this conversation, I want you to remember something. Assets are depreciating. Things that have a useful life depreciate. Land is forever, so it does not depreciate. So if I had land here on the bottom of this house, I cannot depreciate that. So I actually have to subtract from here the land value. So let's say the land value is worth $50,000. So now I have $450,000 as what I would call my structural value to depreciate. So I'm going to get the 450,000 and I'm going to divide it by 27.5 years. And guess what? My deduction is $16,363. So for the sake of this, let me erase that little part right there. Let's do some math together, guys. I had $880 that I made in this property. I'm going to subtract $16,364. Okay, so I'm just going to do that. So 880 minus 16,364. I have a loss, negative $15,484. Negative. So I have now, by the way, remember, real estate is a passive activity, right? So I have $15,000 in a negative passive activity. Now, if I go back to my two buckets, remember, this one is non-passive and this one is passive. I'm trying to get my passive to offset, okay? I can't do it unless a few things happen, okay? So right now, if I don't change anything and I don't have different types of income and all my income, is kind of bundled the same, right now I have $15,484 in a negative loss on real estate. That's how you lose in real estate. Now, the goal is to get this income, this negative rather, to take away from this 200,000. But wait, there's more. So what I just showed you is the traditional way to do this. This is how you do it. You get the property, you subtract the land value, you get the structural value of 450, then you multiply that, or divide that rather, by 27.5 years. You come up with the 16,364, and that's the deduction you use every year. That's it. Okay, that's traditional. I'm going to show you the new way. So we're going to get back to the house. Same thing. Here's our house. And this house, we bought it for $500,000. The land that it sits on, let me put the door because I like the door. Little windows like that. See, you got windows. I'm just being creative now. Subtract 50,000 for the land. So we have minus 50 equals 450. Okay, so we're back to the 450. Now remember, I had 27.5 years as my depreciation schedule. What I want to do is I want to change that. I want to accelerate that. I want this to be so much faster. So what I want to do is I actually want to speed this up. Now what I want to do to speed it up is I'm going to do something called a cost segregation. I can't even spell. All right. And what I'm going to do in this cost segregation is I actually want to tell the IRS that I don't want to take this whole thing as one big chunk. What I want to do, IRS, is I want to say, you know what? See, the useful life of this thing is 27 and a half if it's one big piece. But you know what? How much is a window? And the IRS says, well, that's only 15 years. How much is a door? And they're like, well, that's 5 years. And these are the schedules. How much is a doorknob? And how much is the sink? And all of these are shorter lifespans. Remember, everything has a depreciation schedule. So I said, okay, cool. Let's take the windows. Let's take the door. Let's take the doorknob. And let's just pretend there's shingles here. We'll take the shingles. Right? I'll take those. You know what? I'm going to go inside. I'm going to take the cabinets. And then I'm going to go in here and I'm going to take the toilet. And I'm going to take it all into big pieces, little pieces, little pieces, little pieces. And that's what you call a cost seg. All right. So I go to this cost seg situation and I accelerate it. Now, what I've learned from doing this for a while is that typically, if I can accelerate it, I'm going to accelerate into 5, 7, and 15 years in most cases. So I'm going to find every piece and I'm going to either make it into a category of 5 years, 7 years, or 15 years. Now, anything that falls into this 5 years, what I could do is I could tell the IRS there's a code, and it's code section 179. And 179 lets me make the depreciation of something go even faster than 5 years. And anything in the 5, I can change this and say, nope, I want to do it in year 1. And they're like, whoa, okay, David, you're a real smart guy. And I said, yep. So I'm going to take the 1 year. And here's typically how we see the percentages. Typically, we're going to see 25% year 1, typically 45%, right? That is in year 2, right? In year 7. In year 7 is what we're going to see. And then the remaining 30 is going to go here. Okay? Make sure I did that math right. 25 plus 45, that's 70, right? Yeah, that's right. Okay. So we have the 25%. So what I do now, if I know that 25% is going to be done, I'm going to take the 450 times 25%. Let's do the math together. So I'm going to do 450,000 times 25. And I get 112,500. Now, if you remember, I was only getting 16,000 in my original deduction. So I was only going to get a $16,000. Now, if you remember my scenario, I still had $880 in income, right? So if I get the 880 minus $112,500, look at that. Look at this deduction that I'm about to do. Right? $880 minus 112,500. I'm going to lose $111,620. Whoa. Now, if you recall, I had $200,000 in income. Now, if I could unlock the secret, I would take this as a deduction. And now my income drops to about $90,000. I'm actually going to drop my income because I bought this Airbnb. Now, there's some catches, there's some limitations. The limitations are, in order for me to change that passive income to offset my W 2 wages or my business, the way I have to do it is I actually have to become a manager of my rental property. In this case, the Airbnb. Now, let's go back here real quick. So, if we're here, in order for me to actually do this and offset my income, there's a few limitations, or there's a few standards that I must meet. Number one, I have to manage this property 100 hours at a minimum, or more, at least 1 hour more than anyone else, or manage or maintain or furnish or whatever. Plus, I must materially participate. MP. These are MPs. Materially participate. That means I must actually rent it. I must engage with a tenant in most cases. Sometimes I got to clean, sometimes I don't. Now, other people can help you, but you have to do at least a minimum of 100. And if somebody else helps you, they can't do more than 100. If they did 151 hours, that's for anyone else. You must do 152. That's the rule. So you got to be the one upper. You got to be the one upper. All right. You're going to do one more than them. So doing one more than them qualifies you to get what we call the STR loophole. Boom. And now you unlock these losses of $111,000, and now you can take the losses, right? So let's just do the math, right? So we get the 200,000 minus 1111. No. 6200. Oh, I didn't do that right. So you get 200,000. I should be able to do this really easy, but I don't want to get it wrong and then somebody call me out here. Yes. No. Now my income went from 200,000 to 83,000. And now I pay taxes on 88,000. I now pay taxes on this, which is a lower tax bracket. Actually, no, it's the entire year. It's the whole year. So you got a whole year to do it. Oh, well, unless like I buy it today, then I got from here till the end of the year. Good questions. All right, let's go to questions. Let's get some questions in here. What do you got? I'm sure I got a lot of. Oh, man, I must be teaching you guys so well. So well. So my job, by the way, now the topic was short-term rentals equal long-term wealth, okay? Why is this important? If you want to offset your income this year and you want to buy, oh, I had the eraser on, damn it. And you want to buy Airbnbs as a strategy, this would be your strategy. And I like Airbnbs a lot. However, I would say that buying an Airbnb should not be, actually, let's just transition to just talks now. I'm not going to teach anymore because I want to talk. Well, actually, hold on. Leave me there. Actually, I should talk here. Let me do this. I want you to know something. There's three, and I love this, right? There's short-term rentals. There's long-term rent. Oh, actually, I messed that up. I don't want to. I want to list them right. There's short-term rentals. There's mid-term rentals. There is long-term rentals. Okay, these are the three categories. Now, I always tell my clients when I'm talking to a client, and they're like, David, what should I buy? Do I buy a short-term? Do I buy a mid-term? Or do I buy a long-term? And every time they talk about this one, they're like, dude, I could get a beach house. I could buy a house near Disney. I could buy the condo I always wanted. And I'm like, that's true. However, there are other limitations. You know, in order to get a short-term rental, you have to, you can't stay in it all the time. It actually has to be rented. There's some things you're going to have to, I can't explain it all here today. There's a lot to it, but the concept's there. Okay. So I say short-term rental is good, but there's some negatives, right? So if I had to put a pro and a con here, right? And I drew the line and I said, come on, man, which one? Short-term rental, pro, right? You're going to get tax deduction. right? This one's kind of an easy one. This is the loophole. And then I'd be like another pro, right? Maybe cash flow. And I'm like, yeah, this is great. So I get tax deduction, I get cash flow. Maybe it's a cool property. I'm like, man, this is good. I like it. Now, I'm just going to leave it there. How about cons? Number one, it doesn't rent. What if it doesn't rent? Right? I can't use it all the time. I can't use it actually more than 14 days is the rule. So I'm like, I don't know. In addition to that, if it doesn't rent, expenses are high. Okay, so I got some cons, pros and cons. Tax deduction, cash flow, cool property. Maybe it doesn't rent, right? I can't use it more than 14 days personally, and my expenses are super high. So I'm like, I could do this because I'm like, I love it. I want to do it. But then I'm like, whoa, man, what happens if I don't rent it? I still got to bill, right? I have clients who have beach houses and they try to Airbnb them, which is the right way to do it, but end up coming, $30,000, $40,000, $50,000 negative at the end of the year because they can't rent it all the time. It's just not, sometimes some things are seasonal, and the overheads, the HOAs, the property management fees, all that stuff just goes through the roof at some point. So when I say go get a short-term rental, I may not want you to go find a destination short-term rental. What we want to do is find a midterm or long-term rental that we can temporarily Airbnb, short-term rental, temp. And the amount of time is between where we are today till December 31st. That's exactly how long we want to get there. You go from here to December 31st and you get your short-term rental. After that, we say screw the short-term rental. If we don't like it, maybe it's not cool, maybe it's too expensive, then we start doing long-term, short-term, and we got the tax deduction that we wanted to offset our taxes. So that's the strategy. Short-term rental, long-term wealth, you own the asset, right? The 4 quadrants, right? If we did the 4 quadrants, right? We get the appreciation, we got the equity, we get the cash flow, and more importantly, we got the tax savings. You get all four things here if you do buy real estate, okay? You want all 4. If you get all 4 when you buy real estate, you can. Now, be careful. Some of the things that I'm sharing with you today require you to work with an advisor of some sort to make sure you do this right. There are stipulations to buying short-term, long-term, and midterm rentals. There are things that would require you to do before you buy them or during the process of buying them or the management of them that would qualify you for these deductions that I'm talking about. If you don't have somebody in your corner, I'd love to work with you. TaxPlanExperts.com. TaxPlanExperts.com. Schedule a free discovery call. If I am working with you, thank you. And if you like the information, you just want to get a bunch of free shit, keep on subscribing to my YouTube channel. Watch us live here on Facebook or any other platform that we go live on. I also have free trainings and coachings and all these things that just to give away. The goal is to have an impact on 5 million people over the course of my life. 5 million people to help 2 things. I'm going to write this down so everybody gets it. 2 things I want you to do. Out of 5 million people, I want you to keep and grow. Okay? These are the 2 things I want you to do with your money so that you can build something that's unshakable, undestroyable, unattainable by most. I want you to go build your own economy. Okay? Guys, God bless you. Thank you so much for watching live.